Before we begin, it's crucial to understand that I am not a licensed financial advisor, mortgage loan originator, or underwriter. This presentation is for educational and informational purposes only and should not be considered financial or legal advice. The mortgage process is incredibly specific to each individual's financial situation. Please consult with a qualified and licensed mortgage professional and a financial advisor to receive guidance tailored to your unique circumstances. Imagine this for a second. You've done everything right. You saved for years, sacrificing vacations and nights out. You polished your credit score until it gleamed. You found the perfect house, the one with the big backyard for the dog and the kitchen you've been dreaming about. Your loan officer pats you on the back, gives you a pre-approval letter, and you feel like you're on top of the world. You sign the contracts, you pay for the inspection, you order the appraisal. You're telling your friends you're picking out paint colors. You are just 1 week from closing. Then your phone rings. It's your loan officer, but his voice is different. He says 2 words that make your stomach drop to the floor. Underwriting denied. It's over. The dream evaporates. And you're left asking one question: why? The answer lies with the most powerful, most mysterious, and most misunderstood person in the entire home buying process: the mortgage underwriter. This person, who you will never meet, never speak to, and never even know the name of, holds the fate of your home loan entirely in their hands. They are the final gatekeeper to the American dream. And almost everything you think you know about what they want is probably wrong. You think it's just about having a high credit score and a good job? That's what the surface-level advice tells you. But I have seen people with 800 credit scores and 6-figure incomes get denied flat out, while others with 680 scores and modest job sail through to the closing table. The difference? The second person understood the underwriter's secret language. They understood the hidden rules of the game. In this video, I am going to pull back the curtain. I'm going to take you inside the mind of a mortgage underwriter. I'm not just going to give you a checklist. I'm going to reveal their entire thought process, the psychology, the risk assessment, and the hidden tripwires that cause 90% of last-minute denials. By the time you're done watching this, you won't just have a pile of documents. You will have a bulletproof application. You will know how to present your financial life in a way that makes an underwriter's only possible response a resounding approved. So let's get into it. Underwriters operate on a framework. It's not magic, it's a system. For decades, it's been known as the 3 C's of credit. But today, in the post-2008 world of hyperscrutiny, it's really evolved into what I call the 4 pillars of approval. Those pillars are capacity, capital, collateral, and character. Every single piece of paper you submit, every number on your application, is designed to satisfy one of those 4 pillars. If you have a weakness in one, you must be overwhelmingly strong in the others to compensate. If you fail on any one of these pillars, you are denied. It's that simple. We're going to break down every single one, but we have to start with the first and most important pillar: capacity. Capacity is not just about how much money you make. That's a rookie mistake. Capacity is an underwriter's assessment of your proven ability to repay the loan. See the difference? It's not about your future potential. It's about your past performance and current stability. The primary tool they use to measure this is your debt-to-income ratio, or DTI. Your DTI is the single most important number in your mortgage application, period. It tells the underwriter what percentage of your gross monthly income is already spoken for by debt. There are 2 parts to this. The first is the front-end ratio, which is your proposed new housing payment. That's principal, interest, taxes, insurance, and any HOA fees, divided by your gross monthly income. Most lenders want to see this number below 31%. But the one that really matters is the back-end ratio. This is the big one. This is your new housing payment plus all your other monthly debt obligations, divided by your gross monthly income. What counts as debt? Think car loans, student loans, credit card minimum payments, personal loans, child support, or alimony. Everything that shows up on your credit report. For a conventional loan, the absolute maximum DTI is typically 50%, but underwriters get extremely nervous once you push past 43%. They see high DTI as a massive red flag that you're living too close to the edge, with no room for error if life happens. But here's the secret that nobody tells you. Your DTI is only half the story of capacity. The other, more critical half is the quality and stability of your income. An underwriter is a historian. They don't care about the huge commission check you got last month. They care about the documented, predictable, and continuous income you've earned over the last 2 years. Let's break down how they view different types of income. If you're a W-2 salaried employee who has been at the same job for over 2 years, you are an underwriter's dream. Your income is stable, predictable, and easy to verify with pay stubs and W-2s. It's a green light. But what if you're a W-2 employee who gets paid hourly or relies on overtime or bonuses? Now it gets complicated. The underwriter will not just take your word for it. They will demand your last 2 years of W-2s and tax returns. They will average out that variable income over a 24-month period. Did you have a monster year last year but a weak year before that? Too bad. They're going to average it, which means the income you can actually qualify with might be far lower than what you're earning right now. They need to see a consistent history of you receiving it, and a strong likelihood that it will continue. Now let's talk about the group that gets scrutinized the most: the self-employed, the freelancers, the 1099 contractors. If this is you, listen closely. You are considered a higher risk. Full stop. It's not personal, it's statistical. Your income is variable by nature. To prove your capacity, you will be put under a microscope. You must provide a minimum of 2 full years of personal and business tax returns. And here's the painful part. The underwriter is not looking at your gross revenue. They are looking at your net income after all business expenses have been deducted. I've seen this crush so many entrepreneurs. They'll say, "But I grossed $200,000 last year." But their tax returns show they wrote off $120,000 in expenses. So their actual qualifying income is only $80,000. That's the number the underwriter uses for your DTI calculation. You must show a 2-year history of stable or increasing net income. If your income declined from 1 year to the next, even by a little, you've just raised a giant red flag. You will have to write a detailed letter of explanation, and even then, your chances of approval just went way down. The underwriter's job is to build a story of stability. Every document is a piece of that story. A recent job change? They'll want to know if it's in the same field. A gap in employment? You better have a rock-solid explanation. Any inconsistency between your application, your pay stubs, and your tax returns will be found. They use a verification of employment form that they send directly to your HR department, asking not just about your current salary, but about your likelihood of continued employment. Capacity is the foundation of your entire application. If you don't have the clearly documented, stable, and sufficient income to support the new mortgage payment on top of your existing debts, nothing else matters. Your 820 credit score won't save you. Your huge down payment won't save you. You have failed the first and most fundamental test. So you've proven you have the income. You've documented it perfectly over a 2-year period, and your DTI is in a great spot. You've passed the first pillar. But now the underwriter asks a new question. Where is the money for your down payment and closing costs actually coming from? This brings us to the second pillar: capital. And the mistakes people make here, often with the best of intentions, are the silent killers that torpedo deals right before the finish line. So let's talk about these silent killers. When an underwriter looks at your bank accounts, they aren't just checking to see if you have enough money. They're acting like a financial detective, asking one single critical question about every dollar. Where did this come from? Their entire job is to verify the source and history of your funds. Why? For 2 very important reasons that have nothing to do with judging you. First, they're hunting for undisclosed debt. Imagine you have $50,000 for a down payment, but a week before you applied for the loan, your parents transferred you $20,000 to get you there. To you, it's a loving gift. To the underwriter, without proof, it's a giant question mark. Is it a gift? Or is it a loan? If it's a loan, that's a new monthly payment you have. A payment that wasn't disclosed on your application. A payment that changes your debt-to-income ratio and could be the very thing that disqualifies you from the mortgage. They need to prove that money is a true gift, with no expectation of repayment, before they can count it. The second reason is much more serious, and it's not bank policy, it's federal law. Banks are on the front lines of fighting money laundering. Under regulations like the Bank Secrecy Act and the Patriot Act, they are legally required to report suspicious activity and ensure that the millions of dollars flowing through the mortgage system aren't the proceeds of illegal activities. A sudden, large, unexplained cash deposit in your account looks exactly like what they are trained to flag. So when they ask for documentation on a $5,000 deposit, they're not being difficult. They're doing their legal duty to ensure the money is legitimate. This brings us to the 2 most important words you will ever hear when it comes to your money in the mortgage process: sourced and seasoned. Source means exactly what it sounds like. The underwriter can trace the source of the funds. A paycheck from your employer? Sourced. A tax refund from the IRS? Sourced. A transfer from your own separate savings account? Sourced. A grocery bag full of cash you've been saving for 10 years? That is the definition of unsourced funds, and it's a deal-stopping problem. Seasoned means the money has been sitting in your account for a long enough period that the bank considers it your own. No questions asked. The standard look-back period for an underwriter is the last 60 days of your bank statements. That's 2 full statement cycles. Any large deposit that appears in that 60-day window needs to be sourced. But a large sum of money that was in your account before that 60-day period? That's considered seasoned. It's your asset and they typically don't ask where it came from. This is the single most powerful strategy you can use. Get your money in order long before you apply. Understanding this concept helps you avoid the mistakes that torpedo deals. Let's talk about the biggest one, the cash catastrophe. Let's say you sell your old car for $7,000 cash. Or you have a garage sale and make $2,000. Or you work a side job waiting tables and you've saved up $10,000 in tips. You go to the bank and make a huge cash deposit. You're proud of your savings. But you have just created a 5-alarm fire for the underwriter. They see $10,000 appear from thin air. They have no choice but to ask you to source it. How do you prove where a pile of cash came from? It's nearly impossible. I saw a deal almost fall apart because of this. A couple had been diligently saving cash from a small side business. A month before they found their dream home, they deposited $15,000. The underwriter immediately flagged it. The couple said, "It's from our business." The underwriter said, "Show me the invoices. Show me the receipts. Show me the paper trail." They didn't have one. The lender refused to count that $15,000 toward their closing costs. The only thing that saved them was that they were able to delay the closing for 2 more months, an eternity in a real estate transaction, until that deposit was officially seasoned and past the 60-day look-back period. They almost lost the house because of a simple cash deposit. The fix? If you have cash, deposit it into your account 3, 4, even 6 months before you ever plan on talking to a lender. Let it season. If you absolutely have to deposit cash during the process, create your own paper trail. If you sell a car, write up a bill of sale with the buyer's information and a copy of the vehicle title. Take a picture of the car. Make a photocopy of the check if they pay that way. Document everything so you can hand the underwriter a complete story, not a mystery. Next is the dreaded gift money mistake. Family wants to help, which is amazing, but how they help is critical. Your dad can't just Venmo you $25,000 with a good luck emoji. That's an undocumented transfer from an outside source. To do it right, you need a formal gift letter. This is a standard document your lender provides, where the person giving the money signs a statement declaring it is a bona fide gift and not a loan. But here's the part that trips everyone up. The underwriter then needs to source the funds from the giver. That means your parents or family member will have to provide their bank statement showing they had the money to give, and that it didn't just mysteriously appear in their account either. This can feel invasive and awkward, so prepare your family for it ahead of time. The best practice is to talk to your loan officer before any money is moved. Then we have the trap of the digital wallet shuffle. In the last 60 days, you transfer $3,000 from your PayPal account into your checking. To you, that's just moving your money. To an underwriter, it's a large, unsourced deposit. They don't know if that's income from a secret second job, a loan from a friend, or proceeds from selling stuff online. You will now have to provide your entire PayPal history for that period, explaining every single transaction that added up to that $3,000. The same goes for Venmo, Zelle, or any other peer-to-peer payment app. These are not bank accounts. During the mortgage process, your bank account should be a pristine, quiet, boring place. Paychecks in, normal bills out. That's it. Don't move large sums around. Don't pay your friend back for pizza with a transfer from your down payment fund. Keep it simple. What about using retirement funds like a 401k? This is a very common and acceptable source for a down payment. You can prove where the money came from with a statement. But there's a catch. If you take a 401k loan, the underwriter will count the new monthly loan payment against you in your debt-to-income ratio. This is a crucial detail. I've seen people solve their down payment problem by taking a 401k loan, only to create a DTI problem that gets their mortgage denied. You have to account for the payment. A 401k withdrawal is different. It's not a loan, so there's no payment to add to your DTI. But it often comes with huge tax implications and penalties, and it can signal to an underwriter that you're in a precarious financial position, forcing you to raid your future to afford a house today. Finally, the underwriter isn't just looking at your down payment. They are looking for what's called reserves. This is the money you will have left over after paying your down payment and all your closing costs. It's your emergency fund. The lender needs to know that if the water heater explodes the day after you move in, you won't have to choose between fixing it and paying your mortgage. They want to see that you are not financially depleted by this transaction. How much do you need? The general rule of thumb is between 2 and 6 months worth of your total future housing payment. That's your principal, interest, taxes, and insurance or PITI. So if your total mortgage payment is going to be $3,000 a month, they'll want to see that you have between $6,000 and $18,000 left in the bank after closing. Having strong reserves makes you a much stronger borrower in the underwriter's eyes. It's one of the most underrated factors in getting an approval. It shows you're not just able to buy the house, you're able to afford to live in it. It demonstrates stability. So you've proven you have the cash and it's all legitimate, sourced, and seasoned. You have reserves in the bank. But having money is one thing. How you've handled other people's money in the past is the subject of the underwriter's most intense investigation. This is where they dig into your credit, and what they're looking for goes way beyond just a 3-digit score. Think of your 3-digit credit score as the cover of a book. It might be shiny, it might be tattered, but it tells you almost nothing about the story inside. The underwriter doesn't just glance at the cover. They read every single page, every chapter, every footnote of your financial life story. And that story is your credit report. What they're looking for isn't just a number, but a pattern, a narrative of responsibility, or a history of risk. The first, and by far the most important chapter they turn to is your payment history. This accounts for a massive 35% of your credit score. And to an underwriter, it's a direct reflection of your character. It answers the most fundamental question they have. When you borrow money, do you pay it back on time? It's that simple. They will scan every single account you've ever had listed on that report: credit cards, car loans, student loans, personal loans, even old store cards you forgot you had. They're looking for a clean, unbroken chain of on-time payments. A single 30-day late payment from 2 years ago might seem like a small blip to you. You were on vacation, you forgot, you paid it as soon as you got the notice. But to an underwriter, that blip is a question mark. Why did it happen? Was it a simple oversight or a sign of financial distress? One late payment can often be explained away with a simple letter of explanation. But 2, 3. Now you're not telling a story of a simple mistake. You're telling a story of a habit, a pattern of irresponsibility. And if you were late on a $200 credit card bill, what's their assurance you won't be late on a $3,000 mortgage payment? A 60-day late payment is a much bigger red flag. And a 90-day late payment is a siren. It tells the underwriter that for 3 straight months, you ignored calls, emails, and letters. It signals a major financial problem or a complete disregard for your obligations. Seeing this on a report, especially within the last 2 to 3 years, can be an absolute deal killer for many loan programs. It doesn't matter if your score has since recovered. The scar on your report remains, and the underwriter sees it in high definition. They are trained to believe that past behavior is the best predictor of future behavior. Next, they flip to the chapter on how much you owe. This is your credit utilization, and it's the second most important factor. This isn't just about the total amount of debt you have. It's about how much of your available credit you are currently using. Imagine you have 3 credit cards, each with a $10,000 limit, for a total of $30,000 in available credit. If you have a $500 balance on one card and 0 on the others, you're using less than 2% of your available credit. To an underwriter, this looks fantastic. It says you have access to credit, but you don't need to rely on it to live. You are in control. But let's say you have a $29,000 balance across those same cards. You're 97% utilized. You might be making every payment on time, but you are screaming financial distress. An underwriter sees this and thinks, this person is living on the edge. They are completely reliant on credit to get by. What happens if their car breaks down? What happens if they have a medical emergency? There is no cushion. They see you as being one unexpected expense away from a financial catastrophe, and they are not going to add a massive mortgage payment on top of that precarious situation. The general rule of thumb is to keep your utilization below 30%, but the best qualified borrowers, the ones who get the smoothest approvals, are often below 10%. Maxed out credit cards are one of the fastest ways to get a denial, even with a high income and a history of on-time payments. Then comes the length of your credit history. The underwriter is looking for seasoning. They want to see that you've successfully managed credit over a long period. A borrower with a 15-year credit history, complete with a mortgage, a car loan, and several credit cards all paid as agreed, is a known quantity. They have a long proven track record. A borrower whose oldest account is a credit card they opened 18 months ago is a mystery. Sure, they've been perfect for a year and a half, but that's not a very long story. It's not enough time to see how they handle a real-world financial challenge. This is why closing your oldest credit card, even if you don't use it, can be a terrible mistake. You're not just closing an account, you're erasing the most established chapter of your financial story, which can cause your credit score to drop and make you look like a less experienced borrower in the underwriter's eyes. They also look at your credit mix. An underwriter feels more confident in a borrower who has successfully handled different types of debt. Someone who has paid on a car loan, an installment loan with a fixed payment, and managed credit cards, a revolving loan with variable payments, has demonstrated they can handle the kind of financial responsibility a mortgage requires. A file that only contains 3 credit cards doesn't show that same level of experience. It's not necessarily a negative, but it doesn't build the same robust picture of reliability. They want to see that you can walk and chew gum at the same time, financially speaking. Finally, the underwriter looks for the villains of your credit story. The derogatory marks. These are the things that go beyond a simple late payment. We're talking about accounts in collections, charge-offs, judgments, tax liens, and the ultimate villain, bankruptcy. A collection account, even for a small amount, is a huge problem. Let's say you have an old $50 medical bill you never knew about that went to collections. To you, it's a nuisance. To the underwriter, it's an unpaid debt. It shows that a creditor had to give up on you and sell your debt to a third party just to try and get something back. The lender is not going to approve a $400,000 loan for someone who has a track record of not paying a $50 bill. You will almost always be required to pay off or settle any collection accounts before your loan can be approved. A charge-off is even worse. This means the original creditor has officially declared your debt a loss. They've written it off their books. This is a clear signal that you completely failed to pay your obligation. And public records like a bankruptcy or a tax lien, these are the nuclear options. A bankruptcy, especially a recent one, tells a story of complete financial collapse. While it is possible to get a mortgage after a bankruptcy, there are mandatory waiting periods of several years, and you'll need to demonstrate a perfect record of rebuilding your credit since. The underwriter even scrutinizes your recent credit inquiries. If you've applied for 10 new credit cards and 2 car loans in the last 6 months, they're going to get nervous. It looks like you're desperately seeking credit, a behavior known as credit seeking. It suggests your financial situation might be getting worse, and you're trying to open up new lines of credit to stay afloat. They'll want a detailed explanation for every single inquiry on that report. So you can see the underwriter isn't just looking at a score. They are a forensic accountant and a biographer rolled into one. They are piecing together the narrative of your financial life to answer one single question. If we lend this person hundreds of thousands of dollars, what is the probability, based on everything they have ever done with borrowed money in the past, that they will pay us back on time every single month for the next 30 years? Your credit report is your answer. But a perfect story of credit responsibility can be completely overshadowed by a single devastating number that has nothing to do with your FICO score. It's a ratio, a simple calculation that can single-handedly destroy your chances of getting a mortgage, and it's the number one reason that seemingly perfect applicants get denied. This number is your debt-to-income ratio, DTI. It's a simple fraction, but it's the lens through which an underwriter sees your entire financial life. It's not about how much money you have in the bank or how responsible you were 5 years ago. It's about right now, this month. It answers one single brutal question. Can you actually afford this house on top of the life you're already living? Think of it this way. Your credit score is your financial report card. It shows how you've handled debt in the past. But your DTI is a live stress test. It measures the pressure on your current monthly budget. An underwriter sees a high DTI and they don't see a person with a nice car and a college degree. They see a tightrope walker in a hurricane, one unexpected gust of wind, a car repair, a medical bill, and the whole thing comes crashing down. That's the risk they are obsessed with mitigating. They aren't just lending you a lump sum of money. They are betting on your ability to make a payment every single month for the next 30 years. Your DTI is their crystal ball for that bet. So what is it exactly? The formula is deceptively simple. It's your total monthly debt payments divided by your gross monthly income. Let's say that again because the details here are what trip everyone up. Total monthly debt payments divided by your gross monthly income. Let's break that down. Gross monthly income is the easy part. It's your salary before taxes, before your 401k contribution, before your health insurance is taken out. If you make $80,000 a year, your gross monthly income is $6,667. That's the number the bank uses. Now for the hard part, your total monthly debt payments. This is where the dream of homeownership often dies a quiet death. This includes every single recurring debt that shows up on your credit report. Your car payment, your student loan payments, the minimum payments on all your credit cards, even if you pay them off in full each month. The underwriter only looks at the required minimum payment. Personal loans, alimony, child support, it all goes into the pot. And then, the most important part, the calculation also includes the future housing payment for the very mortgage you're applying for. This is called PITI, principal, interest, taxes, and insurance. And if applicable, HOA fees. The underwriter adds the estimated monthly cost of the new house to your existing pile of debt. Let's see this in action. Let's meet Sarah. Sarah has a fantastic job, making $90,000 a year, or $7,500 a month. Her FICO score is a stellar 790. She's never missed a payment on anything. She's saved up a 20% down payment. On paper, she is the perfect applicant. She finds a home and applies for a mortgage where the total monthly payment, the PITI, is going to be about $2,500. Now let's look at Sarah's life. She's responsible. She has a reliable car she bought a couple of years ago. The payment is $550 a month. She has student loans from getting her master's degree. They're currently in an income-based repayment plan, so she only pays $250 a month. And she has a couple of credit cards. She uses one for gas and groceries and pays it off every month, but its required minimum payment is $50. Another was used for a new washer and dryer, and its minimum payment is $75. To Sarah, this is all perfectly manageable. Her total debt payments are just $925 a month. It's nothing. She feels financially secure. But the underwriter sees a completely different picture. Here's the underwriter's math. They take Sarah's existing debts, $550 for the car, $250 for the student loan, $50 for one credit card, $75 for the other. That's $925. Then they add the new proposed mortgage payment of $2,500. Sarah's new total monthly debt obligation, in the eyes of the bank, is $3,425. Now they divide that by her gross monthly income of $7,500. $3,425 divided by $7,500. That equals 0.456. To get the percentage, we multiply by 100. Sarah's debt-to-income ratio is 45.6%. And just like that, with one simple calculation, Sarah, the perfect applicant, gets a denial letter. Why? Because for most conventional loans, the absolute maximum, the red line do not cross DTI limit, is 43%. 43 cents of every single dollar she earns before taxes would be going out the door to service debt. To an underwriter, that's not a safe bet. It's a gamble. Sarah is denied, and she is completely blindsided. She thought her 790 credit score and hefty down payment made her invincible. But she was wrong. This brings us to a critical piece of insider knowledge. There are actually two DTIs the underwriter looks at. The one we just calculated is the most important one. It's called the back-end ratio. It's the one that includes all your debts plus the new housing payment. But there's also something called the front-end ratio. This one only looks at your housing payment. In Sarah's case, you would just take her proposed $2,500 mortgage payment and divide it by her $7,500 income. That gives her a front-end DTI of 33%. While lenders look at this, it's the back-end one, the 45.6%, that truly matters. A person can have a perfectly acceptable front-end ratio but get denied because of their back-end ratio. That car, those student loans, they create a silent drag on your borrowing power. And Sarah's situation is extremely common, but it gets even trickier. What if her student loans were in deferment? Many people think if they're not paying on them, the loans don't count. That is a catastrophic mistake. If you have deferred student loans with no required monthly payment listed on your credit report, the underwriter won't just ignore them. They can't. Instead, they are required by lending guidelines to use a hypothetical payment. Typically, they will calculate a payment equal to 1/2 of 1%, or even 1% of the total loan balance. Imagine Sarah had $80,000 in student loans in deferment. An underwriter using the 0.5% rule would hit her with a hypothetical $400 monthly payment for DTI purposes, even if she's actually paying zero. If they use the 1% rule, it would be an $800 a month phantom payment added to her debt load, absolutely crushing her DTI ratio and getting her in instant denial. This is a bomb that goes off in the middle of thousands of applications every single month, from people who had no idea it was coming. The same goes for co-signing. Did you co-sign on a car loan for your kid in college? Even if they make every single payment perfectly and you never spend a dime, that full monthly payment, let's say $400, is counted as your debt in the DTI calculation. Unless you can provide 12 months of bank statements from your kid proving they made every payment, that debt is legally yours, and it will count against you. So what are the magic numbers? For a conventional loan, the kind most people get, lenders really want to see you under 36%. They can often stretch to 43% if you have other compensating factors, like a huge down payment or massive cash reserves. Some government-backed loans, like an FHA loan, can be more lenient, sometimes stretching to 50% or even higher in rare cases. But that flexibility often comes with a cost, like higher mortgage insurance premiums for the life of the loan. The underwriter's job is to build a case for you being a good risk. When your DTI creeps up past 40%, you're making their job incredibly difficult. Every dollar you owe on a car, a student loan, or a credit card is a dollar you can't use to get the mortgage you want. It directly and brutally reduces your purchasing power. That's why you can be pre-approved for a $400,000 loan, then go out and buy a new car for $30,000, and suddenly find your pre-approval is worthless. That new $600 monthly payment didn't just add a small expense. It fundamentally changed the core risk calculation of your entire financial life. Understanding this ratio, this single number, is the key to unlocking the entire underwriting process. It's the silent gatekeeper. And once you see how they calculate it, and more importantly, what they include in that calculation, you can finally start to control your own destiny in this process. You can stop guessing and start strategizing. But simply knowing what DTI is isn't enough. The real question is, if your DTI is too high like Sarah's, what can you actually do about it? How can you fight back against this number? It turns out there are specific, powerful strategies you can use to lower your DTI, often much faster than you think. And they aren't the ones you'd expect. The first instinct for most people, the advice you hear everywhere, is the snowball or avalanche method. Pay off your smallest debt first for a psychological win, or pay off your highest interest debt to save money. And for long-term financial health, that's great advice. But a mortgage underwriter isn't your financial coach. They are a risk analyst. They don't care about your long-term interest savings. They care about one thing and one thing only, your documented recurring monthly liability. Let's go back to Sarah. She has that 45% DTI. The common advice would tell her to look at her debts. Let's say she has a $10,000 student loan with a $150 monthly payment, and she has a car loan with just $3,000 left on it, but the monthly payment is $400. The snowball method screams, pay off that tiny car loan. You're so close. The avalanche method might point to a high-interest credit card. But the underwriter's method, the one that actually gets you the house, points to the debt with the highest payment-to-balance ratio. Think about it. That $400 car payment is a sledgehammer to her DTI. The $150 student loan payment is a tap hammer. To an underwriter, that $400 payment is $400 of risk every single month, regardless of whether the balance is $3,000 or $30,000. So the first, most powerful strategy is to ignore conventional wisdom and attack the debt with the highest monthly payment, especially if its balance is relatively low. Sarah realizes this. Instead of scattering her extra savings around, she launches an all-out assault on that car loan. She pulls $1,000 from savings, works a few extra shifts, and in 2 months that $3,000 balance is gone. Poof! That $400 monthly payment vanishes from her credit report. It's not there anymore. So when the lender repulls her credit and recalculates her DTI, that $400 is no longer in the equation. Her monthly debt obligations just dropped by $400. Let's do the math. Her income was $6,000 a month. Her old debts were $2,700. Her DTI was 45%. Now, her debts are $2,300. $6,000 divided by $2,300. Her DTI just plummeted to 38%. 38%. She went from a denial to a prime candidate in 60 days. Not by getting a massive raise, not by waiting years to pay off all her debt, but by surgically removing the one payment that was doing the most damage. This is a critical distinction. You're not trying to become debt-free, you're trying to reduce your monthly obligations on paper. But what if you can't pay off a loan that quickly? What if your highest payment is on a $15,000 loan and you just don't have the cash? This is where we get into the second, more advanced strategy. It feels counterintuitive and some financial gurus would probably scream, but it is one of the most effective tools for mortgage qualification. It's called debt restructuring. This isn't about just moving deck chairs on the Titanic. It's about swapping out a bunch of small leaky lifeboats for one bigger, more efficient vessel. Let's imagine a different scenario for Sarah. She has 3 credit cards with minimum payments of $75 each. That's $225. She has a personal loan for some old furniture with a payment of $200. And that same car loan at $400 a month. Total monthly payments, $825. The balances might be high, and paying them off would take years. So what does she do? She goes to her bank or a credit union and applies for a single debt consolidation loan. Let's say the total balance of all that debt is $18,000. A bank might offer her an $18,000 loan on a 5-year term. The interest rate might even be a little higher than her car loan, which feels like a bad move. But remember the goal. The goal is not to win a Nobel Prize in economics. The goal is to lower the monthly payment. Because the new loan is spread out over a longer term, 5 years, the monthly payment might be, say, $450. Now look what just happened. She still has $18,000 in debt. Her net worth has not changed by a single penny. But on her credit report, and in the eyes of the underwriter, her monthly debt obligation just went from $825 down to $450. She just freed up $375 in her DTI calculation, almost overnight. The underwriter isn't going to call her and say, "Wait a minute, Sarah. You just took on a new loan to pay off old loans, and you might pay more interest in the long run." The underwriter will see a credit report that shows the old accounts are paid and closed, and there is one new installment loan with a documented $450 monthly payment. They will use that number. It's clean, it's simple, and it works. This is a powerful, powerful tool. You are essentially trading long-term interest costs for short-term monthly cash flow, which is the exact variable the underwriter is solving for. It's a calculated trade-off. You're making a strategic decision to optimize your financial snapshot for the single purpose of passing the underwriting test. After you close on the house, you can go back to aggressively paying down that new loan, following the snowball or avalanche method to your heart's content. But to get through the gate, you have to play the game by their rules. There's another version of this too. Let's say you have a large amount of student loan debt. By default, many lenders have to use 1% of your total student loan balance as a monthly payment, even if your actual payment is zero because you're in deferment. If you have $100,000 in student loans, they'll hit you with a phantom $1,000 monthly payment, which can absolutely destroy your DTI. The strategy here? Get on an official income-driven repayment plan, or an IDR. If you can provide the underwriter with official documentation from your loan servicer that your new, official required monthly payment is, say, $172 a month, they are often required to use that number instead of the 1% calculation. You could take your DTI from 50% down to 41% with a single phone call and a few forms. These aren't loopholes. They are established rules of the system. The underwriter isn't trying to trick you. They are following a manual, a very specific, rigid manual. And your job with your loan officer is to present them with a file that checks every single box in that manual. By paying off a high payment, low balance loan, or by restructuring your debt to lower the total monthly outflow, you are simply changing the data they have to input into their formula. You are handing them a file that, by their own rules, they have to approve. Sarah did it. She used these strategies. Her file, once a clear denial, now looks pristine. Her credit is solid, her income is verified, and her DTI is a beautiful 38%. The underwriter stamps the file. The loan is clear to close. It seems like the final hurdle has been cleared, but the underwriter isn't done. They verified your ability to pay in the future, based on your income and debts. Now they have to look at the past. They have to look at your money, specifically the cash you have saved for your down payment and closing costs. And they're about to open up her bank statements and scrutinize every single dollar. They're not just looking to see if you have enough money. They're looking for where it came from. And a single innocent-looking deposit from 2 months ago is about to raise a giant red flag that could put the entire deal in jeopardy. This is the moment where a dream home can turn into a paperwork nightmare. The deposit was for $10,000. It came from the bride's parents, a generous wedding gift meant to help with the down payment. To the couple, it was a beautiful gesture. To the underwriter, it was a $10,000 undocumented liability. It was an anonymous pile of cash that appeared out of thin air. And the underwriter's job is to assume the worst. Their first thought isn't, "Oh, what a nice gift." Their first thought is this a loan? Because if it's a loan, a secret, off-the-books loan from a family member, that's a new monthly payment. And that new monthly payment has to be factored into their debt-to-income ratio. A secret loan could be the very thing that pushes their DTI over the lender's limit, instantly disqualifying them. So the underwriter has to investigate. They have to prove that this gift is, in fact, a gift. This entire process boils down to two critical concepts every homebuyer needs to burn into their memory: sourcing and seasoning. Let's start with seasoning. Lenders want to see that the money you're using for your down payment and closing costs has been sitting in your account for a while. The standard look-back period is 60 days, which covers 2 full bank statement cycles. Any money that has been in your account for longer than 60 days is considered seasoned. It's your money. The lender generally won't ask where it came from. But any large, non-payroll deposit that shows up within that 60-day window is considered unseasoned, and it will be scrutinized. The underwriter will demand to know its origin. This is sourcing. You have to be able to provide a clean, clear paper trail that shows exactly where every single one of those unseasoned dollars came from. This is where the infamous mattress money problem comes in. Imagine you've been saving for years, stashing away a few $100s in cash every month in a safe at home. You finally saved up $20,000. You find the perfect house and you go to the bank and deposit that $20,000 in cash into your checking account so you can write the earnest money check. You've just created a 5-alarm fire for your underwriter. A $20,000 cash deposit is one of the biggest red flags in all of mortgage lending. There is no source. There's no paper trail. It just appeared. The underwriter has no way of knowing if you saved that money over 10 years or if you borrowed it from a loan shark last Tuesday. More importantly, large cash deposits trigger federal anti-money laundering alarms. Under the USA Patriot Act, banks are required to report suspicious activity to the government. A sudden large cash deposit by someone trying to get a massive loan absolutely qualifies. The underwriter isn't just protecting the bank at this point. They're complying with federal law. They cannot and will not approve a loan with a large unsourced cash deposit sitting in the file. That $20,000 you so diligently saved is now unusable for your home purchase. You would have been better off leaving it in the safe and not even mentioning it. You needed to deposit that money slowly over many, many months, or put it in the bank at least 3 months before you even thought about applying for a loan, so that by the time the underwriter looked at your statements it was fully seasoned. So what about the $10,000 gift from the parents? It wasn't cash, it was a check. That's better, but it's still unseasoned, so it has to be sourced. And this is the part that shocks most buyers. To source the gift, you don't just need to prove you received it. You need the person who gave you the gift to help prove where they got it. First, the underwriter will require a gift letter. This is a formal document signed by the parents stating their names, their relationship to you, the exact dollar amount of the gift, and a sentence that is legally critical. This is a bona fide gift, and there is no expectation of repayment. But the letter alone is not enough. The underwriter needs to see the money move. They will ask for a copy of the canceled check from the parents that you deposited. Then they will ask for a copy of your bank statement showing that exact check being deposited into your account. And here's the kicker. They will often ask the parents to provide a copy of their bank statement from the month they wrote the check, showing the $10,000 being withdrawn from their account. People find this incredibly invasive. The parents are thinking, why do I have to show my personal bank statement to my kid's mortgage company? The reason is a full circle verification. The underwriter needs to see the money leave a documented, seasoned account, the parents, and arrive in another documented account, the buyers. This proves it wasn't a loan from some shady third party that was just funneled through the parents. Proves the money is legitimate. So what counts as a large deposit that needs to be sourced? It varies by lender, but a common rule of thumb is any single, non-payroll deposit that exceeds 50% of your total gross monthly income. So if you and your spouse make a combined $10,000 a month, any deposit over $5,000 that isn't from your job is likely going to get flagged. Some lenders are even stricter. flagging any non-payroll deposit over $1,000. The key is to be prepared. So what are the acceptable, good sources for your funds to close? Number one, of course, is your regular paycheck deposited from your employer. That's the gold standard. Second is money that has been seasoned for over 60 days in a checking, savings, or money market account. Third is the sale of a documented asset. If you sell your car to raise money for the down payment, you'll need to provide the underwriter with a copy of the bill of sale, a copy of the check you received, and your bank statement showing the deposit. Same goes for selling stocks. You'll need the brokerage statement showing the sale and the transfer of funds into your bank account. Fourth is a loan or withdrawal from your 401k. This is very common, but you have to provide all the paperwork. If it's a 401k loan, the underwriter will add that new monthly payment into your DTI calculation. And of course, fifth is a properly documented gift, complete with the gift letter and the full paper trail from the donor's account to yours. The unacceptable sources are the deal killers. Large cash deposits, as we discussed. Unsecured loans. Taking out a personal loan to get money for your down payment is strictly forbidden. The down payment has to be your own funds, not another loan you took on. Using a credit card cash advance is the same thing, it's just more debt, and it's a massive red flag. And finally, any undocumented transfers from friends, family, or mysterious sources. Every dollar needs a name and a history. The underwriter is like a financial archaeologist, digging through your recent past. They aren't trying to judge you. They are trying to reconstruct a story that proves to the bank and to the government that you are a stable, reliable borrower with legitimately sourced funds. They are building a case for your loan's approval. They've now stress-tested your income, your credit history, and your assets. They've confirmed you have the capacity to pay, the character to pay, and the capital to close. The 3 C's are clear. But there is one final massive piece of the puzzle that has nothing to do with you at all. It's the 4th C, collateral, the house itself. The underwriter's job is also to ensure that the asset the bank is lending on, the house, is actually worth the price you're paying. And to do that, they rely on one of the most nerve-wracking parts of the entire home buying process, the appraisal. And what happens when that appraisal comes in low is a crisis that can shatter a deal in a single afternoon. Imagine this: you get the call. It's your loan officer, but their voice is different. The cheerful optimism is gone, replaced by a kind of gentle professional dread. They tell you, the appraisal came in. You hold your breath. And then they drop the bomb. It's low. In that moment, the entire foundation of your deal begins to crack. The home you've already decorated in your mind, the neighborhood you pictured your kids playing in, it all hangs in the balance because of a single number on a sheet of paper. This is the appraisal crisis, and for an underwriter, it's not a crisis at all. It's the system working exactly as intended. To understand why, you have to understand what an appraisal actually is. It's not just a formality. It is an independent, professional, and brutally objective opinion of a property's fair market value. The key word there is independent. The appraiser doesn't work for you, the seller, or even the lender. They are a third-party, licensed professional whose only job is to determine what that house is truly worth in the current market on that specific day. They are the ultimate reality check. So how do they conjure up this magic number? It's not magic, it's data. The primary method is called the sales comparison approach. The appraiser becomes a detective, hunting for comparable properties in the immediate vicinity that have sold recently, ideally within the last 3 to 6 months. They're looking for homes that are as similar to yours as possible. Same number of bedrooms and bathrooms, similar square footage, similar age, similar condition, and on a similar sized lot. They take the sale prices of these comps, and then they make adjustments. For example, if your target home has a brand new, top-of-the-line kitchen, but the comp a block over has a kitchen from 1985, the appraiser will add value to your property. If a comp has a 2-car garage and your house only has a 1-car, they'll subtract value. They factor in the location. Is it on a quiet cul-de-sac or backing up to a noisy highway? They look at the overall condition. Is the roof nearing the end of its life? Are there cracks in the foundation? They are looking at the cold, hard facts of the property, not the emotional value you've placed on it. That beautiful paint color you love? Worth 0 to an appraiser. The fact that it's 5 minutes from your parents' house? Worth 0. They are building a case brick by brick, data point by data point to justify a final number. And that final number is what the underwriter is waiting for. For them, the appraisal confirms the C for collateral. It is the bank's ultimate protection. They need to know that if the absolute worst happens, you lose your job, you can't make payments, and they have to foreclose, they can sell the house and get their money back. The bank will only lend you money based on the purchase price or the appraised value, whichever is lower. This is one of the most important rules in all of mortgage lending. Let's play this out with a real-world example. You've agreed to buy a house for $500,000. You've saved up a 20% down payment, which is $100,000. You need a loan for the remaining $400,000. The underwriter has approved your credit and your income. The last piece of the puzzle is the appraisal. Scenario 1. The appraisal comes in at $505,000. Everyone breathes a massive sigh of relief. The underwriter sees that the collateral is worth even more than the purchase price. The loan-to-value ratio is solid. They stamp it approved, and you move toward closing. But scenario 2 is the phone call you dread. The appraisal comes in at $470,000, a $30,000 gap. Suddenly, alarm bells are ringing in the underwriting department. The underwriter now sees a house that's only worth $470,000, but you're trying to get a loan based on a $500,000 price. From their perspective, you are overpaying by $30,000, and they will not finance that overpayment. The math changes instantly. The bank will now only lend you 80% of the appraised value. 80% of $470,000 is $376,000. But you need a $400,000 loan to buy the house for $500,000. You are now short $24,000 on the loan, and you have that $30,000 gap between the price and the value. The deal is on the verge of collapse. The underwriter has drawn a line in the sand, and they will not cross it. So what happens now? You essentially have 4 options. Option 1 is the simplest and, for most people, the hardest. You, the buyer, cover the entire $30,000 gap in cash. In addition to your original $100,000 down payment and closing costs, you'd need to bring another $30,000 to the table just to make the deal work. For the vast majority of buyers who have stretched and saved for years, this is simply not possible. Option 2 is to go back to the seller and renegotiate. This is where your real estate agent earns their commission. You go to the seller with the appraisal report in hand. It's a powerful piece of evidence, and you say, "Look, an independent, bank-ordered expert has determined your house is only worth $470,000. I can't get a loan for $500,000. You need to lower the price to match the appraisal." Now the seller is in a tough spot. If they say no, they lose you as a buyer, put the house back on the market, and there's a very good chance the next buyer's appraisal will come in at the exact same number. They might get angry, they might be insulted, but faced with the reality of the market, they will often agree to lower the price. Option 3 is the most common outcome: a compromise. Neither side wants the deal to die. You don't want to lose the house, and the seller doesn't want to start over. So you meet in the middle. Maybe the seller agrees to lower the price by $15,000 to $485,000. And you agree to bring an extra $15,000 in cash to the table to cover the remaining gap. It's painful for both sides, but it saves the transaction. The underwriter will be happy with this, as long as the new loan amount is still justified by the appraised value. Then there's option 4, the Hail Mary. You can challenge the appraisal. This is called a reconsideration of value. It is an uphill battle, but it's not impossible. You and your agent can't just say, "We think it's worth more." You have to provide new, hard data that the appraiser missed. Did they overlook a recent sale on the next street over that's a much better comparison? Did they use a foreclosure or a short sale as a comp, which unfairly dragged down the value? Did they make a factual error, like listing the house as having 2,000 square feet when it's actually 2,200? You submit this new evidence to the lender. The underwriter will review it and send it back to the appraiser for a second look. Sometimes appraisers will adjust their valuation. More often, they will stand by their original report. It's a long shot, but it's a shot worth taking. And if none of these options work, you don't have the cash, the seller won't budge, and the appraisal challenge fails, you have your final safety net: the appraisal contingency in your contract. This clause allows you to walk away from the deal and, crucially, get your earnest money deposit back. It's a heartbreaking decision to make, but that contingency exists for this exact reason: to protect you from knowingly overpaying for a home. For the underwriter, this entire drama is just risk management. They aren't just looking at the final number either. They're reading the entire appraisal report, looking for red flags. The appraiser might note that the roof has less than 5 years of life left, or that there's evidence of water damage in the basement, or that the back deck was built without a permit. Any of these comments can cause an underwriter to pause. They might add a condition to the loan approval, stating that the roof must be replaced before closing. This ensures the bank isn't lending on a property that requires immediate, expensive repairs. They want a clean, problem-free asset. So the appraisal is the ultimate test of the property itself, the objective voice of the market that cuts through all the emotion. But even with a perfect appraisal, a stellar credit score, and rock-solid income, an underwriter can still deny a loan in the final hours. Because they have one last crucial job to do: verifying that nothing has changed. And they do this by looking at your life under a microscope one last time right before closing. This final check is often called the soft pull, or the credit refresh. And it is the graveyard of so many home buying dreams. You see, after weeks of being told don't touch your credit, some buyers get their conditional approval and think they're in the clear. They think the race is over. So they go out and finance a brand new $7,000 refrigerator, or a living room set, or worse, a new car to put in the driveway of their new home. They see the finish line, and they start celebrating before they've crossed it. And that is a catastrophic mistake. Because that soft pull the underwriter does is specifically designed to catch exactly that. It's not another full-blown hard inquiry that will ding your score. Instead, it's a report that shows the lender if any new accounts have been opened, if any new credit inquiries have been made, or if the balances on your existing credit cards have suddenly skyrocketed. The underwriter isn't reevaluating your entire credit history. They are looking for one thing and one thing only: change. Imagine the underwriter's screen. Your file is open. Your debt-to-income ratio is calculated down to the decimal point, sitting right at a pre-approved 42.8%. It's tight, but it works. Then they run the credit refresh, and a new alert pops up. A new auto loan, $35,000. Monthly payment, $650. In an instant, the underwriter plugs that new number into their calculator. Your DTI doesn't just nudge up. It pole vaults to 47.9%. A siren goes off in the system. The loan is now outside of guidelines. The approval is instantly invalidated. And just like that, 72 hours before you were supposed to get your keys, the entire deal collapses. All for a car you haven't even driven off the lot yet. This is not a scare tactic. It happens every single day. The underwriter's logic is ruthless and simple. The loan was approved based on a specific financial snapshot. If that snapshot changes, the approval is void. Any new debt, no matter how small it seems to you, is a material change to your financial profile. That $5,000 furniture loan might only be $150 a month, but that could be the exact $150 that pushes your DTI over the edge. So the rule is absolute. From the moment you apply to the moment the keys are physically in your hand, your financial life must be frozen in carbonite. No new credit, no new loans, no large purchases on existing credit cards. You are in a financial lockdown. But the credit refresh is only the first part of this final audit. The next step is arguably even more personal. The underwriter or someone from the lender's office will pick up the phone and call your employer. This is called the final verbal verification of employment, or VVOE. They did this once at the beginning of the process, and now they are doing it again, sometimes on the very day of closing. And the questions they ask are brutally direct. They aren't calling to chat. They're calling to confirm three things. 1. Is Jane Doe still employed at your company? A simple yes or no. If the answer is no, the loan is dead on arrival. It doesn't matter if you quit to take a better job that starts next week. It doesn't matter if you were laid off yesterday with a huge severance package. To an underwriter, no longer employed means no longer has the income we used to approve this loan. Stability is everything, and you just proved you have none. 2. Is she still in the same position with the same pay structure? This one trips people up. Let's say you got a promotion. Great, right? Not necessarily. If your pay structure changed from a stable, predictable salary to one that is now heavily based on commission, the underwriter gets nervous. Commission income is considered variable and often requires a 2-year history to be used for qualifying. You might be making more money, but in the underwriter's eyes, your income just became less reliable. The deal is now in jeopardy. And 3, the most important question: what is the likelihood of continued employment? They are literally asking your boss if they think you're going to keep your job. Most human resources departments will give a standard, neutral answer. But if there have been recent company-wide layoffs, or if your department is being shut down, that information can and will be relayed to the lender. The underwriter isn't just concerned about your job today. They are underwriting your ability to pay this mortgage for the next 30 years. Any hint of future instability can be enough to put the brakes on the entire deal. So while you're at home packing boxes, dreaming of paint colors, an underwriter is on the phone with your boss, effectively asking if you're about to get fired. It's a sobering thought. This is why you never, ever quit your job or change jobs in the middle of a home purchase without talking to your loan officer first. Can be an instant denial right at the finish line. The final piece of this pre-closing audit is your cash, your assets. The underwriter needs to be sure that the money you said you had for the down payment and closing costs is still there. They don't want to find out at the closing table that you took $10,000 out of your savings to buy crypto or put a down payment on a boat. So what do? They may ask for the most up-to-the-minute bank statement you can provide. A screenshot from your online banking portal showing your current balance, dated that day. They are re-verifying two things. First, that the funds for closing are still present and accounted for. If you needed $80,000 to close, and your account now only has $65,000, you have a massive problem. But they're also looking for something else. They're scanning for any new large unusual deposits. Remember how we talked about sourcing your funds? That rule applies right up until the very end. If a mysterious $20,000 deposit appears in your account 2 days before closing, the underwriter will demand to know where it came from. If it was a gift from your parents, you should have already had a gift letter executed and documented. If you can't prove it was a legitimate gift, the underwriter will assume the worst, that it's an undisclosed loan from a friend or family member. And an undisclosed loan means undisclosed debt, which means your DTI is now wrong. And the loan gets denied. Credit, employment, and assets. The 3 pillars of your loan approval are checked, double-checked, and triple-checked right up to the final hour. This is why the phrase "clear to close" can be so misleading. It doesn't mean the work is done. It means you are cleared to close on the condition that nothing changes. It is a provisional green light, and it can be switched back to red in a heartbeat. The underwriter's job is to protect the bank's investment. They are the final gatekeeper, and their job is to ensure the person they're lending hundreds of thousands of dollars to is the exact same person, in the exact same financial condition, as the one they approved 3 weeks ago. Any deviation is a red flag. Any change is a potential denial. They will scrutinize your life under a microscope until the very second the money is sent. But here's the secret that almost no one tells you. Even after the underwriter gives their final sign-off, they aren't the last person to look at your file. There's one more gatekeeper, a final boss, if you will. This is the person who actually controls the bank's money, the wire transfer. They're known as the funder, and the funder can, and often does, add their own last-minute requirements, known as funding conditions, that can stop a closing debt in its tracks, even as you're sitting at the table with a pen in your hand. Imagine this. You're at the closing table. The title agent has just slid a stack of documents in front of you that's thicker than a phone book. Your real estate agent is smiling, your loan officer is on standby, and the sellers are probably packing their last box. You pick up the pen. Your hand is literally shaking with a mixture of excitement and sheer terror, and your phone buzzes. It's your loan officer. Their voice is tight. "Don't sign anything yet. We have a problem. There's a funding condition." That single phrase is one of the most heart-stopping moments in the entire home buying process. Because a funding condition isn't a suggestion. It's a non-negotiable demand from the person holding the purse strings, the funder. This isn't your underwriter anymore. This is the final boss. The funder works for the lender's treasury or wire department, and their sole job is to protect the bank's cash. They are the last line of defense before hundreds of thousands of dollars leave the bank's vault and are wired to the title company. And they take that job very seriously. Before they release that wire, they do one last final review of your file. They are looking for any red flags, any changes, any reason at all to slam on the brakes. The underwriter might have given you the clear to close, but the funder gives you the clear to fund. And they are not the same thing. So what are these last-minute grenades they can throw into your closing? The most common and most terrifying is the verbal verification of employment, or VVOE. Sometime in the 24 to 48 hours before your closing, often just hours before, the funder will personally call your employer. They have one goal: to confirm you are still actively employed and your income status hasn't changed. Now think about all the ways this can go wrong. What if they call your company's main line and get a new receptionist who doesn't know you? What if your HR manager is on vacation? What if it's a Friday afternoon and everyone has gone home early? What if your boss, the only one authorized to verify this, is on a plane? I have seen deals delayed for hours, sometimes even pushed to the next day, because the funder couldn't get a live human on the phone to say, "Yes, John Doe still works here." It is an absolute white-knuckle moment. And God forbid, if you've been laid off or quit your job between getting your final approval and sitting at the closing table, the deal is dead. Instantly, the funder will cancel the wire, and your homeownership dream evaporates right there in the conference room. The next landmine is the credit refresh. Just before funding, the lender will do a soft pull on your credit. It doesn't affect your score, but it shows them everything they need to see. Specifically, they're looking for new accounts or new debt. This is the exact reason every loan officer screams from the rooftops: do not make any large purchases before you close. Don't finance furniture. Don't lease a new car. Don't even open a new credit card to get 10% off at a department store. Here's why. Let's say your debt-to-income ratio was approved at 44%, just under the wire of the 45% maximum allowed for your loan program. You get excited, you think you're in the clear, and you go lease a new SUV because your old car is on its last legs. That new $700 a month car payment just showed up on your credit refresh. The funder sees it, reruns the numbers, and your debt-to-income ratio is now 48%. The loan is no longer in compliance. The funder will immediately halt the closing. The deal isn't necessarily dead, but you are now in a frantic scramble. You might have to pay off other debts, bring more cash to closing, or even return the car to get the deal back on track. The funder doesn't care about your transportation needs. They care about the mathematical risk profile you presented, and you just changed it at the worst possible moment. Another classic funding condition is a last-minute request for updated bank statements. They want to see that the money you said you had for the down payment and closing costs is still there. They're looking for two things: that the money hasn't been spent, and that no new large mysterious deposits have appeared. If you paid your rent or made a big credit card payment and the balance dropped significantly, you'll get a panic call asking you to explain where the money went and prove you still have enough to close. If a new large deposit shows up, maybe a last-minute gift from a relative that you forgot to document, you're going to have to stop everything and produce a gift letter and source the donor's funds, just like you did weeks ago. It's a delay you simply don't have time for. Even something as simple as your homeowner's insurance can trigger a funding condition. The funder will review the insurance binder, which is the proof of coverage. They will check that the coverage amounts are sufficient, that the effective date is on or before your closing date, and most importantly, they will check the mortgagee clause. This little block of text lists the lender as an interested party. If your lender's name is ABC Mortgage Corporation, ISAOA, which means its successors and/or assigns, and your insurance agent just put ABC Mortgage, the funder will reject it. A single typo, a missing word, can put a stop to everything until your insurance agent can be reached to issue a corrected document. And if it's 5 p.m. on a Friday, you might be waiting until Monday. The funder is also the final inspector of the closing documents prepared by the title or settlement company. They scan every page of the closing disclosure, the note, the deed of trust. They are looking for perfection. Is your name spelled correctly on every single page? Is the property address 100% accurate down to the zip code? Do the loan amount and interest rate match the underwriter's final approval exactly? If they find a single clerical error, they will kick the entire package back to the title company for correction, reprinting, and re-signing. So when a funding condition arises, a flurry of desperate activity begins. Your loan officer, the processor, the title agent, and you are all in a mad dash to satisfy the funder's request. It's a high-pressure, time-sensitive crisis. You're sending frantic emails from your phone, making calls from the closing room, trying to track down an HR manager or an insurance agent while the clock is ticking. Once all of these last-minute hurdles are cleared, and every single condition has been met to the funder's satisfaction, they do one thing. They issue the funding authorization number. This is the holy grail. It's a simple string of numbers and letters, but it's the golden key that unlocks the money. The funder transmits this number to the title company. Only when the title agent has that authorization number can they legally disperse the funds. They can pay off the seller's mortgage, pay the real estate agents, pay themselves, and officially record the deed in your name. That funding number is the final, definitive yes from the lender. It's the moment the loan officially becomes real. The wire is sent, the transaction is complete, and the keys to your new home are finally truly yours. You've survived the final trial by fire. But just because you have the keys and the moving truck is backing up to the curb, Don't think the lender's file on you is closed and forgotten. Far from it. The underwriter's work is still being scrutinized. Because after the chaos of closing dies down, a whole new process begins. The chilling world of the post-closing audit. And what they find there can have consequences you never imagined. Think of it like this. The mortgage closing is the big, public wedding ceremony. The vows are set, the papers are signed, the keys are handed over. Everyone celebrates. But the post-closing audit? That's the private investigator hired by the wealthy in-laws, digging through every detail of the relationship weeks later to make sure everything is legitimate. This isn't about you anymore. It's about the money. Your loan file, which you thought was closed and collecting dust in a digital archive, is reopened. It gets pulled into a queue for the lender's quality control, or QC department. These are often the most senior, most experienced, most cynical underwriters in the entire company. They've seen every trick, every lie, every corner cut. Their only job is to re-underwrite a random sample of closed loans with a single brutal question in mind. If I had gotten this file, would I have approved it? But why? Why go through all this trouble after the deal is done? Because your loan wasn't just a transaction between you and your bank. In all likelihood, your bank has already bundled your mortgage with hundreds of others and sold it as a security on the secondary market to a massive investor like Fannie Mae or Freddie Mac. In doing so, your lender made a promise, a set of representations and warranties, that your loan met dozens, if not hundreds, of specific, non-negotiable guidelines. The post-closing audit is the lender's last chance to make sure they didn't sell a faulty product. It's their internal inspection before the big investors do their own. So what are these QC auditors hunting for? Everything. They're not just recalculating your debt-to-income ratio. They're stress testing the entire file. They're looking for the subtle cracks the first underwriter might have missed under the pressure of a closing deadline. Did the original underwriter use the correct income from your variable bonuses? Did they properly document the source of that large gift deposit from your parents? Was the appraisal report truly independent? Or does the appraiser do a little too much business with the loan officer, suggesting a potential conflict of interest? They'll scrutinize the title report for any new liens that might have popped up at the last second. They'll re-verify your employment after you've closed, to make sure you didn't quit your job the day after you got the keys. They're looking for any deviation from the rulebook, no matter how small. And when they find something, the consequences ripple outwards. Let's say the QC auditor discovers the original underwriter miscalculated your income. It was an honest mistake, but it pushed your debt-to-income ratio 0.5% over the allowable limit. For the underwriter, this is a finding. It goes on their permanent internal record. Too many findings, and they're looking at mandatory retraining, a reduction in their lending authority, or even termination. Their career is built on a reputation for accuracy, and a QC audit is the ultimate judge. But for the lender, the stakes are so much higher. If the QC department finds a significant error, what's known as a material defect, it means the loan is potentially ineligible for sale. Or worse, if it's already been sold, they now live in fear of the investor finding the same mistake. Because if Fannie Mae runs its own audit and finds that same income miscalculation, they will invoke the lender's worst nightmare: a repurchase demand. A repurchase demand, or a buyback, is exactly what it sounds like. The investor forces the original lender to buy the loan back at face value. Suddenly, that $300,000 loan they thought was off their books is back, and it's a toxic asset. They can't resell it because it's defective. They're stuck with a bad loan, a huge financial loss, and a black mark on their reputation with the most powerful investors in the country. A handful of buybacks can cripple a small mortgage lender. A wave of them can put a company out of business. This is why the QC audit is so ruthless. It's a multi-million-dollar firewall. Now you might be thinking, okay, that's fascinating for the bankers, but what does this have to do with me? I have the keys, I'm paying my mortgage. I'm safe, right? For the most part, yes. If it was an honest mistake by the lender, the battle is fought behind the scenes between them and the investor. Your loan terms likely won't change. But the audit isn't just looking for lender mistakes. It's also the final and most powerful tool for uncovering borrower fraud. Remember that bank statement you edited in Photoshop to hide a withdrawal? Or that side business you conveniently forgot to mention? Or the gift letter you faked from a relative who never actually gave you the money? The initial underwriter might have missed it. But the QC auditor has more time, more tools, and more suspicion. They might run a forensic analysis on the PDF of your bank statement. They might do a deep dive public record search and find your undeclared LLC. They might actually call your relative to verify the gift funds. And if they find conclusive evidence of fraud, everything changes. The protections you thought you had vanish. Most mortgage agreements have a fraud clause that essentially says if you lied in your application, all bets are off. The lender can have the legal grounds to call the loan, demanding you repay the entire mortgage balance immediately. If you can't, they foreclose. You lose the house, you lose your down payment, and your credit is destroyed for a decade. And it gets worse. If the fraud is significant enough, the lender won't just take the house back. They will report it. They will create what's known as a Mortgage Asset Research Institute report, which gets shared throughout the industry. You'll find it nearly impossible to get another mortgage ever. And for the most egregious cases, organized schemes, forged documents, identity theft, the FBI gets involved. What started as a little white lie to get a better interest rate can end with you facing federal charges for bank fraud, carrying penalties of up to 30 years in prison and $1 million fine. Those are the consequences you never imagined. So when we ask what a mortgage underwriter is looking for, the answer is so much bigger than just your credit score and your pay stubs. The frontline underwriter is looking for a reason to say yes, while protecting their company from risk. They are the gatekeepers. But the QC underwriter, the auditor in the shadows, is different. They are looking for the one tiny loose thread that, when pulled, can unravel the entire deal. They are the guardians of the system. The underwriter's job isn't to be your friend, and it's not to be your enemy. Their job is to be the impartial, unflinching arbiter of fact in one of the biggest financial stories you will ever tell. They read the story you submit, your career, your savings, your debts, and their signature is the final chapter, attesting that your story is true. So the single greatest piece of advice anyone can give you when applying for a mortgage is this: tell a clean, honest story. Because long after you've moved in and unpacked the boxes, someone somewhere will be reading it again. And they will be checking your work.